Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
All right, let's just dive right in. We're looking at AI Era Corp, ticker ABQQ, and the market mechanics here are nothing short of shocking. I mean, this is a company that's gone from, obscure cinema licensing to an AI play.
And it's trading in the absolute depths of the sub-penny market. We're talking between $0.0001 and $0.0003 a share. It's almost at zero.
Exactly. But here's the paradox. They filed their financials for fiscal year 2025, and they reported $6.37 million in revenue, and get this, a net income of $1.46 million. The entire company's market cap is only about $1.62 million. It doesn't add up.
So that's the debate, right? Is the price being held down by this, structural black hole of dilution and toxic debt? Or is this all just a game of retail sentiment driven by this new AI story they're pushing?
And I'm firmly on the side of structure. I think the math of the capital stack makes the AI narrative, frankly, almost irrelevant to the actual value.
And I see it differently. I think in this really unique environment, sentiment and these big strategic moves like the reverse split they're planning are what's actually driving the bus right now.
Okay, so for me, the immovable object here, the thing you just can't get around, is the share count. I mean, the sheer gravity of it. This company went from about 4.82 million shares outstanding in 2020 to over 8.12 billion shares by late 2025.
That is a 169,000% increase.
It is. It's a number that's hard to even comprehend. It mathematically forces the value per share down to these levels. I mean, you could argue their AI asset is worth $100 million, and it wouldn't matter. You divide that by 8 billion shares, and you're still looking at pennies. This is an evaluation problem. It's a structural death sentence.
And that's driven by the debt, right?
Completely. It's classic death spiral financing. They're using these convertible notes. You see them from lenders like Emma Financial that have a variable conversion price. So the lender gets to convert their debt into stock at a huge discount, say 35 or 40%, to whatever the lowest recent trading price was. It's an engineered feedback loop of destruction. The lender converts, they immediately sell, that selling pushes the price down, and that new lower price just means the company has to issue even more shares the next time. It's relentless.
I don't disagree. That mechanism is absolutely toxic. But a stock trading at 0.0002 isn't a math equation. It's a psychology experiment. And my whole point is that all the recent action is being dominated by these strategic catalysts they're throwing out there to try and grab the narrative back.
Such as?
Well, first, the pivot itself. Rebranding to AI Era Corp. That's a very deliberate move. They're trying to get out of the old media bucket and into the high multiple tech world. That name change alone attracts algorithms, keyword scanners, a whole new class of speculative trader. And then you have the second catalyst, which is just the sheer audacity of the $5 million share buyback they announced.
The one that's bigger than the entire company.
Exactly. It's 3 times the market cap. And look, we all know it's probably not fully executable, but the psychological impact of announcing that, it's huge. It's a PR move designed to create a floor of sentiment, to get people excited ahead of this big reset they're planning. You couple that with the lotto ticket mentality of retail traders who see a move from 0.0001 to 0.0003 as a 200% gain, and suddenly that sentiment becomes its own reality, at least for a while.
I see why you think that, but we have to go back to the forensic evidence that just guts that whole narrative. We have to talk about the accounting. That $1.46 million in net income, I believe it's largely an accounting mirage. It's a function of the stock price collapsing.
You're talking about the derivative liability, ASC 815?
Am. So explain to everyone why that rule basically turns their financial collapse into a reported gain on paper.
Well, simply put, those convertible notes are considered derivatives. They are a liability on the books. Because the stock price is cratering, the value of the company's obligation to convert that debt into stock, that liability, it goes down. And under accounting rule ASC 815, That decrease in liability gets booked as a non-cash gain on the income statement.
So the more the stock price crashes, the more profitable they appear? It's an insane paradox. Their operational business is losing money, but the accounting for their toxic debt makes them look healthy. I mean, their own auditors have issued going concern warnings.
It is a brutal paradox, so you're saying the market is trading where it is not despite their profitability, but basically because of the very mechanism that creates that fake profitability.
Exactly.
But let's challenge that for a second. If the structure is the only thing that matters, why didn't the stock just go to zero when they announced they were still negotiating with these same lenders? The fact that it's holding this, sub-penny floor shows that the speculation is creating some support. And that brings me back to the $5 million buyback. Yes, it's PR, but in this world, PR is capital. Announcing a buyback 3 times the size of your company is designed to be shocking. It grabs headlines. It buys them time.
But how can you give any credibility to a $5 million buyback when, as I said, their own auditors issue a going concern warning? I mean, let's be clear what that means. The auditor is officially stating they have substantial doubts the company can even stay in business for the next year. You can't execute a massive buyback when you're totally dependent on more toxic financing just to keep the lights on. The market did react skeptically. The price stayed pinned to the floor. It confirms that smart money is looking at the cash crisis, not the press release. The 8 billion shares, that just outweighs any temporary hype.
The skepticism is warranted. I'll give you that. But let's shift to how these trades are happening, because this is where retail sentiment really shows its muscle. The retail investors in this stock are constantly pointing to the off-exchange short volume ratio, which has been up near 85%, as proof of some, grand conspiracy. Naked shorting, market suppression, they call it.
And we need to dissect that forensically. Because isn't that high ratio just a technical reality of how over-the-counter, or OTC, stocks trade when wholesalers are internalizing orders?
You're absolutely right. It is. An 85% off-exchange ratio on an OTC stock is usually just a technical artifact of liquidity provision. It's not necessarily a directional bet against the stock.
Can you explain that?
Sure. Wholesalers like Citadel or Virtue, they internalize all these small retail buy orders. So when a trader buys 1,000 shares, the wholesaler technically sells short to them from their own inventory to fill the order instantly. Then they go out and balance their books later. So all that volume is just, the plumbing of the OTC market, not some coordinated attack.
Exactly my point. The cause is technical, it's neutral, it's not some big conspiracy.
I agree. But here's where my argument pivots. The technical microstructure validates the power of the sentiment. An 85% ratio proves one thing. This stock is overwhelmingly being traded by retail investors whose orders are flooding these channels. And that volume is being driven by the Wall Street bets effect. It's driven by a story, a thesis that ABQQ's streaming service is undervalued compared to, say, Tubi. So the microstructure itself is a reflection of just how powerful the speculative narrative has become.
The immediate dynamics might be sentimental, but the long-term trajectory is structural. And all of this is leading to one place, the 1 for 20,000 reverse stock split. This is their Hail Mary pass. They want to turn 8.12 billion shares into about 406,000 shares and get the price up to maybe $4.
It's the highest stakes gamble you can imagine.
It is, and we have a perfect precedent for it. Back in 2019, this same company did a 1 for 50 split. The price popped up to the $5 to $10 range for a moment, but they never fixed the underlying dilution engine. So over the next few years, it just bled out all the way back down to where it is now. History shows a reverse split without fixing the toxic debt is just a temporary cosmetic fix. The selling pressure will come right back, and you'll get that D on the ticker symbol, which is just a scarlet letter for institutions.
Look, the precedent is terrible. I agree. If this is just a repeat of 2019, it'll collapse again, probably faster. But they have to try it. It's the only way out of the sub-penny trap. And the rebranding to AI Era Corp is why they think this time is different. They're trying to have a new, high-growth story ready to tell the second that split happens, to attract institutional money that would have never touched them as a legacy media company. They're hoping the new narrative can absorb this selling pressure.
But that selling pressure is almost a guarantee. You have retail investors who see their 20,000 shares turned into one share, and they just sell out of frustration. And you have short sellers who see an artificial $4 stock as a brand new, easy target. Until FINRA signs off on that split and the company proves it can raise clean capital without the death spiral debt, the structure just guarantees this reset will fail too.
And all eyes are on that FINRA review right now. But for the short-term trader, the whole game is the anticipation of that ruling. The whole game is the potential for a powerful post-split squeeze fueled by that AI hype.
So we're left with a situation where the structure says this is going to zero, but the market mechanics are creating this high-risk asymmetric bet.
The dual reality is undeniable.
So let's sum this up. We've explored this central tension in AI era corp. On one hand, you have the mathematical reality, 8.12 billion shares, and a toxic financing cycle so broken that a falling stock price actually creates paper profits.
And on the other hand, you have these powerful speculative catalysts. You have the AI pivot, that wild $5 million buyback announcement, and this lotto ticket psychology that is driving insane retail volume through the market's plumbing.
It's a battle between forensic details and a high-risk, high-reward swing trade.
Exactly.
My position is unchanged. The structural problem, the share count, is the ultimate predictor here. Until AI era corp proves it can break the cycle of toxic financing and stop the dilution, the structural gravity is the only thing that matters in the long run. The price is just a reflection of the denominator growing faster than the numerator.
And I'll end by saying that while that dilution is the long-term threat, the short-term market is a different beast. It's driven by narrative, by hype, and by the anticipation of this massive 1 for 20,000 reverse split. For now, the market is a battleground where traders are betting on which reality will win out in this very high-stakes corporate reset.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.